because you are focused on what's happening at the bid and the offer, and you can clearly see, it doesn't mean you have to get out of a trade, but if your risk is increasing, let's say you are short, you go short at an area, and the print tells you and it confirms that, yes, the buyers have stepped away, we have more activity at the bid, sellers seem to be stepping in, there's more activity here at the bid. If you're going short, buyers are stepping away, then what do you look for in the print? What changes in the print to tell you, okay, this is changing, my risk is increasing? Doesn't mean you get out of the trade. No, sometimes you need to let the trade work a little bit. But you understand, you'll be able to understand my risk is increasing, and you'll be able to do something about it. So if you're managing a very small account or a smaller account, you can effectively do something before you potentially get stopped out. If then the print then changes back into your favor, you can always get back into the trade. But the point is that you will always be in control, and you will be objective about your trade management and your trading. Very important. Once you're able to do that and you have that control, I'm telling you, your trading will change forever. Once you feel that control, and I've lived this. I know this. I spent a lot of time in a lot of different systems trying to catch a bunch of answers. Right. This is the trading system. This is the solution. Before I got into market auction. And I remember sitting in a trade many times, and I would put the trade on, and I would just hope, oh, please work, please work, please work, please work. I had no idea if that trade was going to work or not. I had no idea if once I got into that trade, my risk was increasing or things were working in my favor, except for watching painfully tick by tick by tick. And if you're trying to make a decision on your trade based on tick by tick by tick, you will always be a subjective trader, and the psychology will overwhelm you. You will second guess yourself every single time. So this is why when we talk about going through psychology, I want to make it really clear that as we go through these fundamentals, as we go through understanding how to read the print, how to relate it to the volume profile using volume cluster analysis and momentum, how understanding those things and always bringing them back to the fundamentals are going to help you maintain objectivity. And understand that you don't control the market, you don't control price movement. All you ever control in your trade or getting into a trade is you. You can control your risk, you can control when you take profit, you can't control price, you can't control price movement. And once you understand that, and you can start saying, all right, my risk is increasing in this trade, I need to, I'm making a conscious decision to manage this trade, or I'm going to let it go, but this is where I'm letting it stop. I want to see what happens at this level, one more price rung higher, and if it does this, then I'm going to get out of the trade, or I'm going to manage the trade this way. When you can start doing that, and you have that level of control, because you are fundamentally understanding what's going on in the auction as you get into your trade, then regardless of the fact that you really don't have control over price, your trading will change because you will have control over yourself. And once you finally get it, once you finally understand that your only control is really over yourself and your own trade, then you understand where your control is. You're able to be a much more objective trader. Now, I'm going to talk about that again and again and again, because from a psychological standpoint, all of these tools, as you will see, work together. And if we get through, well, we'll get through this by the end of the week, but when we get through this by the end of the week, you are going to be able to see how all of these pieces fit together to help you be an objective trader. Now remember, always two prices to consider. They're the bid and the offer at any given time. The gap between them is referred to as the spread with the ES. It's not significance. It's basically a quarter of a point. But simply enough, the spread is the difference between the price that a buyer wants to pay and the price that a seller wants to sell. Naturally, buyers want to buy at a lower price. Sellers want to sell at a higher price. So they make more money. So what that means is that when buyers place market orders, they're saying that they're willing to pay more. I'm a buyer. I have so much conviction. I think price is going up. I'm willing. I need to get into this trade. I'm going to pay more. I'm going to go up to the seller. I'm going to take their their offer. And when sellers place market orders, they're saying that they're willing to sell for less, right? I'm a seller. I really want to sell at this price, but I really think that price is going down. I want to get into this trade. I'm willing to take that buyer's offer for less. They're considered aggressive orders. They show conviction by buyers and or sellers, and it's why we track those in the print. So basically, they have so much conviction that either price is going to move up or down in their direction. They're either willing to pay up or take less for their order. The result of buyer and seller interaction is that price moves up and down in two phases. And we've talked about this. The market moves from balance to imbalance. Every single market does this, balance to imbalance. Balance is where price rotates within a certain range over a specific period of time. So the balance within a day time frame, even within the morning session or afternoon session, may be different and likely will be different than that over a week or over a month. But within a day, and once you start understanding these principles, okay, right now price is in balance, it's in balance, it's in balance. I can see it's in balance because of these characteristics of price movement. I can see it's in balance because at the top of this range, I have buyers going away. I have sellers stepping in at the bottom of this range. I have the bid getting weak, the offers getting strong. I'm in a range. The price is in balance. So what am I looking for? Well, I'm either looking to trade in this balance area at the extremes, or I'm looking for price to start moving out of balance and start seeking new prices. And price shows to be in balance for one of two reasons. It's either building price acceptance for further continuation. This is what happens in a trend. Price moves up, it builds balance, it builds acceptance, or down, and it keeps moving up, and remember, price will continue to move in a specific direction until the other side steps in to shut that movement off. So when a price moves to a new level and it begins to balance, what it means as a trader, because you understand the fundamentals, is okay, price just went out of balance. It's now in an area, it's rotating. Now intraday, that may be for, on the ES, it may be for 15 minutes. In some cases, especially in the last couple of weeks in August, it may be 3 hours that price is rotating in a specific area, getting balance. But your job as a trader, because you understand that the market moves from balance to imbalance, to say, okay, the market's in balance. My trade opportunities are in this balance area. Is this something I want to take? If so, what am I looking for in the print to get into this trade? Knowing that my range in terms of profit is within this balance area. But what do I know as a trader? Well, I know that the market's likely to move out of balance. So I make a conscious decision to say I'm trading in this balance area. Once price starts moving out of the balance area, what am I looking for in the print specifically? Number one, to make sure I'm not just going to get stopped, and that may happen. But what am I looking for in the print specifically to know that the market is now moving again into discovery mode and looking for a new price? The other reason that price shows to be in balance is because the other side's stepping in. They're holding the continuation. Let's say buyers are pushing, and sellers get to a point where they say, nope, we start to see value lower, and they hold, and they keep the buyers from moving higher. What we're going to see is that the market will start to balance and then start to move lower again. Now, imbalance. This is where price is in discovery mode of new prices. They're basically, again, two phases in just about every market. Price is either in balance, or it's in balance or out of balance, and it's in price discovery mode. There are two scenarios for price discovery mode. After it, you get acceptance of price, and so the market moves into balance, or you get rejection of price, and you start getting responsive selling or buying. Responsive selling, responsive buying is in response to price movement. And you can see the reaction in the market, and we're going to take a look at what that looks like in the print. Just to look at responsive buying and selling, it's not just in the letters that pop up above and below your bars. The volume profile in the print will help us to understand which one is happening, and we're going to go through that. So what's interesting as we think about balance and imbalance, balance areas are evidenced by price rotation. Imbalance areas are evident by buyer-seller probe moving into new areas or to an extreme outside of balance. They are pushing, they are testing. In a lot of cases, if price is moving higher, buyers took out sellers. And if buyers just took out sellers, either one of two things happen. We're going to get into this later. Either it's a stop run, right? It's a short-term play, and those buyers saw a bunch of stops above, and they let price move up, and they took out they took those short-term buyers out. It was a stop run, and they moved back in. So one of two things happen here. Balance areas, again, evidenced by probe into new areas. And as it moves outside, it's either going to be a stop or price is going to move and seek new balance area. So if, for example, buyers are taking price higher, sellers have been coming in, it's been rotating in balance. We can see sellers have been hitting the bid as price hits a certain level. And now buyers take it through that level. The volume profile is going to show us, is this a real move? I'm going to show you how to look in the volume profile. Is this a real move, or is this a quick stop run? And what the probability is of it either being a stop run, what to look for in the print, what to look for in the volume profile, to say, no, this is a stop run, I need to be prepared to go short again, or, yep, this is a real move, we're likely to move into new areas, where's my next likely opportunity for price to go to? So you can take advantage of that trade. What's interesting about all this, at least I find interesting, is the result of the market auction are natural movements of probes and rotations. And it gets us into order flow. So it's not by accident that the foundation, the OFA framework, is probe and rotation, because that is what the auction is. The auction in every market is a series of probes and rotations. Now in the ES, we'll see that nuance is a little bit different, actually quite a bit different than instruments like the TF and the CL, where we have much thinner volume, and we can see a range of 50 to 100 plus ticks on oil, which might be a full 10 points on oil, whereas with ES, we're going to see a much smaller range, likely to see a smaller range of 20, 30 ticks in a day. So the probe and rotation settings, we need to understand them relative to the instrument that we're trading. But again, it's no accident that the foundation and framework is probe and rotation, because again, it is what the auction is. And it's the best representation of the auction, the electronic auction. So we're going to begin our discussion of order flow with the importance of this framework as well as the indicator. Now the activities of, let me just stop here and see if there are any questions so far. If you have any questions, I want to give you an opportunity to ask that. Again, some of the key points that I brought out that I want you to write down, that I really want to highlight, is that the market is an auction. And the auction means that we have buyers and sellers engaged. And I don't care if it's high frequency trading, dark pools, doesn't matter what it is. It is buyers and sellers engaging. Even if it's the same entity, just different offices, one's buying, one's selling, and taking advantage of the order flow and liquidity in the market, that happens as well. They're still buying and selling, and they begin to show in the print and in the volume profile what their intentions are. Where is fair price? Where is unfair prices? So the buyers and sellers, they make the auction, they make up the market. It is these buyers and sellers that are going to move price in our favor or against us. They're going to make us win or lose. So it's important that we understand what they're trying to do and how good of a job they're doing on either side of the bid or the ask. We need to put that into context of the overall market and the overall instrument that we're trading in order to find opportunities. Now, some people like to fade trades. They like to take trades in the other direction. Other people love to trade trends. And understanding what the conviction levels are and weakness levels are of the buyers and sellers are going to help you, and looking at the volume profile are going to help you do both. So again, just to summarize, buyers and sellers They create the auction. The auction is represented by this thing called order flow and bids and offers. And those bids and offers create structure in the market that over time tell us what the buyers and sellers are trying to do, and more importantly, how effective they are in trying to do that. So if we can see in the print, we can see in a structure chart with volume cluster analysis and momentum that buyers are in fact getting aggressive, and we can see the volume coming in. What we're looking for is, can they actually move price? Because inherently we should understand that if they can't move price, then there's a likelihood that price will come in the other direction and all of their activity will likely stop them out. So it's two components. We want to understand what buyers and sellers are doing, where their conviction levels are, and then as we look to get into trades, how effective is either side in achieving their objectives and moving price. And it's only those buyers and sellers that actually is going to take us to profitability. So any questions that you all might have before I move on? Because we're going to start getting into the order flow and the probe and rotation settings and things of that nature. Oh, I didn't see all my questions. Let's see. Let's just take a few of the questions. On a macro basis, you can have more people entering the market with intention to buy than with the intention to sell. On a macro basis, intention to buy is a limit order, and intention to sell is a limit order, which is correct, Peter. You can have more people with intention, again, limit orders, getting ready to go in to buy than to sell. And again, what moves price is what buyers and sellers actually do when buyers move up in the offer to take the offer, or sellers move down in the bid to take the bid. And Alan, for some reason I hadn't seen the questions when you said, can I show previous slide? If you could just let me know what I was talking to, I can certainly get back there. I say the market moves from balance to imbalance at the extremes. How do you know it's an extreme? Great question, Roberto. I am going to show you that in the volume profile. It's one of the elements of the volume profile, which I call a finish to an auction, one side or the other. And in fact, as we kind of go through in days 4 and 5, and we start getting actually into the market, based on the print and based on the volume profile, I'm going to talk about things like, okay, this auction is finished to the upside. So this extreme to the upside is done right now. This extreme to the downside is done right now. And what's going to be really cool is the volume profile is going to give you a strong visual signal that an auction is at an extreme and may be ending. I hope I answered that question. I was making notes on the slide. What you said was most important. Could you show it again? Yeah, and that slide, the most important piece that I talked to before was that the essence of when you get into a trade, the only thing that is going to make you successful are all of the orders, and specifically market orders, that come in after you enter your trade. So let's face it, if an indicator tells you get into a trade, if you're not watching the print, let's say it tells you get in long, and you're not watching the print, I mean, let me just see if I can put this over here real quick, just to give you an example. We don't need to get into that right now. I can see weakness at the offer up here. If an indicator told me to get in long at 23.50 because it was some, here was some buying, and I can see activity coming back in at the bid, right now this trade would tell me that I'm at risk. My trade is additionally at risk because I'm getting more activity at the offer. What I want to see, or at the bid, what I want to see is the bid go weak and the offer start to get strong again. So by understanding what's happening at any given time at the bid and at the offer when I'm in a trade, because this is the only thing that matters. This is what's going to take my trade, let's say my long here in front of this cluster, here at 23, the only thing that's going to take this into profitability is what happens after I get into that trade. So what I really care about is what is happening at the bid and the offer after I get into this trade. I can see sellers trying to push price down harder, and I can still see activity coming in at the bid here at 23. If I'm long in front of this area at 23.25, I have an indicator that tells me to get long, and I'm just using this as an example. As I'm reading this print, this starts to tell me, especially with this momentum, neutral auction, selling volume cluster, my trade is at risk. I better manage this trade, take a little bit of a loss, manage this trade. If the print tells me something different, I can get back into the trade. But everything in this auction, once I would get into it, starts to tell me that my trade is at risk. Once I understand that my trade is at higher risk, I can begin to do something about it. And I can manage effectively. And most importantly, I can manage objectively. I don't know what's going to happen next in the market. I don't know if buyers are going to step in, some news is going to hit, and price is going to take off again. But once I'm in a trade, this is my truth. And once I start seeing additional risk happening against my trade, I can effectively and objectively manage. And again, I cannot stress to you the importance of this. And again, it's one of the reasons I am so happy to be doing this with OFA, is because its strength and weakness algorithm at the bid and the offer is what helps me manage my risk. The other things like the volume clusters and the momentum additionally help me manage my risk. So the most important thing that I was going through is once you get into a trade, it is all of these buyers and sellers that are going to take your trade into profit or into loss. And like with this trade, let's say, I got in at this level here at 23.25. It's coming down against me. I move my stop. I say, oh my goodness, this is bad. It's coming down against me. It's got to move up. It's got to move up. It's got to move up. And I keep moving my stop. There is nothing in this auction right now that tells me I don't have continued risk in this trade. Yeah, relative weakness down here at 21.75. But the risk has already occurred. And actually, as I look at this, the potential for this to come down to 21.75 and lower is pretty good. I mean, maybe even all the way back down to 21.25, which was, we're going to get into this later in the day. This was the closing swing high for Friday at 21.25. So the most important thing that I talked to was the fact that all of the orders that come in after yours are what is going to carry you to profit or to loss. You need to fundamentally understand that before you get in the trade, and you need to fundamentally understand that once you're into the trade. If you understand that prior to getting into the trade, you're going to make decisions based on buyer-seller interaction. It doesn't mean that you will always be right, but what it means is that you're going to have a lot more control over yourself, which is the only thing you have control over. And when you have control over yourself, relative to what buyers and sellers are trying to do, you become a different trader, a much more effective trader where you're significantly managing your risk and letting trades move to profit. Let's see. So I hope that was helpful, Alan. I'm going to go through a few more of these questions. Will we learn how to set probe and rotation for different markets? Yes, I'm going to go through that this week. We're going to talk a little bit about it today, and we're going to go through that this week, especially as we start looking at some of the other instruments. I will show you how I set my probe and rotation differently and why I set probe and rotation differently. Oh, absolutely, Michael. Glad that this is helping. Thank you for explaining the market auction process. Here, for me, and this is why it's so important for me to train this, the level of aha and for me, not just in understanding the market auction once I got it, but the level of effectiveness in my trading that it provided for me was monumental. If there was ever a point in time that I could point to in my trading that said this was the change, it was understanding the fundamental and the principles of the auction. So it's why I spent a lot of time here, and I'm glad to do it. Thank you for the comment. Will you be able to identify spoofing in the OFA print? If you mean spoofing like a stop run, then Nestor, what I would tell you is I'm going to show you using the volume profile and the print how you can identify when a stop run is likely occurring. When is a stop run likely occurring? How can you identify it? And more importantly, what to do so you're not frozen in your tracks.